The FHA just cut mortgage insurance, literally lowering the cost of FHA loans, which is really exciting. It hasn't happened in a long time, and it hits the market at just the right time. At the end of the day, it's important to understand that these changes have happened and that you can qualify. And ultimately, you want to consult a trusted loan officer who understands exactly these guidelines and how they apply to your situation. So let's dive in. Let's start with mortgage insurance. In the United States, there are basically two types of mortgage insurance. The first kind is PMI. It actually stands for personal mortgage insurance, which is insurance that you pay to protect your lender if you are unable to repay your loan in the future. Now, you might be thinking, why pay the premium to make sure it's okay if you start defaulting on your payments? But really, that's what most people need to spread, bridging the gap between what a down payment is, what you can do with it, what you can afford, and basically buying a home. If you need to convert less than 20% down payment on a conventional mortgage, you need private mortgage insurance. We'll look at the MIP, the mortgage insurance premium found on all FHA government-insured loans. Today we're talking about MIP mortgage insurance premiums for FHA government-guaranteed loans only. FHA has two premiums. There is an upfront mortgage insurance premium that is basically included in the loan amount, which is 1.75% of the purchase price. So if you bought a house and you're using FHA after the down payment, 1.75% is added to the actual loan amount to calculate your payment, regardless of the loan amount. This is how it changes. The loan amount multiplied by the mortgage insurance prepayment rate is 1.75%, and then added to the loan. Currently, in 2023, the upfront mortgage premium has not changed. Only the annual mortgage premium has changed. Now, annual mortgage insurance is a bit deceptive because you pay monthly. Mortgage calculation method: mortgage annual premium minus FHA is the annual mortgage premium multiplied by the loan amount divided by 12. You will then receive monthly payments, and your monthly mortgage insurance premium will be added to your mortgage payment. Well, it's the same with all FHA mortgages. When you get a federally backed mortgage, you have to make a lot of compromises. Your credit is much less. Score requirements, much lower cost to obtain a loan, and much more flexible debt-to-income ratio. Sometimes it makes sense to take a government-guaranteed loan. And that's how you pay for that little insurance policy to qualify for this loan. Incredible flexibility. Plus the flexibility of underwriting FHA loans. Interest rates tend to be a little lower than usual. But adding mortgage insurance ends up being the same or a little more expensive. And the down payment required is very low. He has one of the lowest down payments on the market at 3.5%. Now, let's look at some examples. The way FHA handles policies is to talk about loan-to-value. So here it is translated and actually replaced it with a 6.5 deposit amount. So what we're going to start with, and what many of you may not have known, is that if you're paying down payment, the minimum down payment is 3.5% of the FHA. But if you bet more in this case, more than 5% down, say 5.5% or 6% down, the cost actually goes down. So let's go back before March 30th and start with the largest possible, smallest possible deposit of 3.55%. Annual mortgage insurance premium is 0.85 points for loan amounts below $625,500. If you go above $625,500 for high-end areas, is 1.05. Currently, this is only allowed in certain areas, and you should check your county-by-county credit limit. You can do this on the HUD website, so you can check your credit limit accurately. Now, let's look at after March 30th. Two things happen. First, the loan limit increase. Now, with Fannie Mae, Freddie Mac, FHA, VA, credit limits have been increased across the board. So due to the cost of living and such maximum loan amounts, the lower traditional you can use is calling and loan. FHA, Fannie Mae, conventional Freddie Mac, conventional VA, or USDA have no actual credit limits, they have income limits. Once you reach the limit that you can use with any of these traditional financings, the loan above the limit is called jumbo. This is another type of financing typically offered by banks and credit unions, and it's just a much higher. This means that if you purchase a home equal to or less than $726,200, your annual mortgage insurance premium will be reduced from 0.85 to 0.55%. It's pretty important. Payments can be in the hundreds of dollars, depending on the amount of the loan. If you are in a high-cost area, and these are coastal areas such as the California coast or the East Coast, some coastal areas of Florida allow higher loan amounts of above $726,200. It's 0.75 down from 1.05. Today, both FHA and VA's loans are federally guaranteed loans with a special feature called streamlined refinancing. So basically, no evaluation is required. No income information is required. All you have to do is make timely payments for at least 6 months, and there must be a tangible benefit. Therefore, the lender has to prove it by refinancing you. First, they lower your interest rate by at least 0.5%. And second, it benefits you as much as you benefit greatly from it. And that hasn't changed. So the reduced mortgage insurance was 0.55, and that hasn't changed. Now, let's talk about 5% or more down. It's not a big difference, but it's a difference. If you're 5% down, you can be 5.5% down, or even 6% down. But if you have a deposit of 5% or more, the figure will actually be 0.8 to 0.5, cheap or expensive. Looking at it, it's 0.85 dropped to 0.55. 105 went to 75. A bet on a down of 5% or more will result in an additional 5 basis points down. And it's the same when you put more than 10% down, equivalent to adding 5% down. In this case, for example, if you have 5, 6, 7, or 8%, then investing more doesn't help either. If you pay the minimum deposit, if you can afford it, that's leverage. And that's probably the wisest thing to do. Keep the rest of your money in the bank. Emergencies are expensive. It's much better to stay liquid and hold on to your money and then invest in home stocks that may not be readily accessible or cheap depending on the market. Let's take an example to show exactly what it looks like. This is a purchase using an FHA loan on a 30-year fixed-rate mortgage. Interest rates on 15-year fixed-rate mortgages or mortgage insurance premiums are also currently falling. Not many people take FHA mortgage of 15 years. However, there are many advantages to using this in this market, especially at this low cost. In this example, the minimum down payment is 3.5% and the loan amount is $500,000. Therefore, note that the mortgage insurance prepayment is 1.75 times the loan amount of $8,750. Therefore, the underlying loan amount for payment is $508,750. Just roll in your old mortgage insurance premiums. Well, it's not in it. It doesn't matter what the market interest rate is. These interest rates would be the highest since 20 to 25 years. It doesn't matter. It's mortgage insurance. So, your old mortgage insurance payments, which were $360 per month for just the annual mortgage insurance for 0.85, dropped to $233.18 for 0.55. It's not a big deal, but you can save more than $1,000 a year. If you keep that loan for 10 years, you'll save about $10,000 to $15,000 because the FHA has cut your mortgage insurance premiums. The other part of this is when you hit a debt-to-income ratio that looks like the maximum debt-to-income ratio to qualify for a loan by reducing your mortgage insurance is one way you can pay less and afford more homes. There is not much you can do to cut your spending, so you can see a slightly more expensive house. But this is one thing that all new home buyers will realize now and in 2023. After March 20th, you'll have a little more purchasing power and you'll get more. This is a really big benefit for FHA flexible loans. FHA is one of the most flexible loan programs on the market. One of the challenges we see as a mortgage broker is the big banks. Your credit union does not make FHA loans. So there are a lot of companies that don't like these FHA or federal loans for whatever reason. So if you're trying to apply for a mortgage and the loan officer turns you down, sorry, your debt-to-income ratio is too high. Check out the FHA because the debt-to-income ratio of the FHA is much higher than conventional loan. In addition, it is much more flexible, and even with a lower credit rating, it will be more flexible and cheaper or less expensive. Conventional mortgages are very expensive if you have a credit score below 700 or 680. High areas, high credit limits, or high-cost areas. So in reality, it's not entirely true. FHA means the loan limit is set by the county. Therefore, you should research the county you live in or the county you buying in to see the maximum loan amount, conventional criteria, or conventional credit limit for conventional loans. Conventional or government is $726,200. If you live in an expensive area, you can get an FHA loan of up to or over $1 million, like California. Lower mortgage premiums mean more purchasing power. Again, the higher debt-to-income ratio compared to conventional loans makes FHA loans a very good low-cost option that doesn't sacrifice costs. If you're going back and forth between FHA and conventional loans, most likely a very good loan officer will walk you through all your options and let you compare FHA and conventional loans. However, if you find yourself in a situation where you do not qualify as a conventional, then FHA is definitely something to consider. So the loan officer will ask if you tried FHA, and if not, find a loan officer who specializes in FHA. This is good news for everyone, even if the median home price did indeed rise. In rural areas, the median U.S. home price is $467,700. This is well below his $700,000 maximum FHA loan limit. Therefore, this is a program that is widely available to almost everyone in the country. Again, to make sure your county has an FHA loan limit, you'll need to look it up. However, most people may qualify in terms of the loan amount. So this gets pretty complicated. And your ability to qualify for a mortgage is literally limited by the experience and effort that the loan officer puts into it. They think there are too many moving parts, too difficult. Therefore, we are willing to listen to you, understand your story, research underwriting guidelines, find your options, present all your options so that you can make an informed decision.